All right, so today we're diving deep into Enron, one of the biggest corporate scandals ever, right? We've had tons of requests to take a closer look at how their business model actually worked, how they pulled off that massive accounting fraud, and of course, who was really responsible.
Yeah, it's a wild story.
It really is.
They were masters of illusion, really,
Wow.
creating this image of success and innovation, but underneath, hiding some pretty dark secrets.
Definitely dark secrets. So before they became like this Wall Street darling, they started out pretty normal, right?
Yeah.
Like natural gas pipelines, not very exciting stuff.
Yeah.
But it seems like even those early days, there were signs of trouble.
Oh, absolutely. In the 80s, they hit this major crisis. It was because of take-or-pay contracts. Basically, they were locked into buying natural gas at these really high prices, even when demand totally tanked.
So they're stuck with all this expensive gas and no one to sell it to. How'd they get out of that?
Deregulation of the energy market. It created all these new opportunities for companies like Enron to move away from those rigid contracts and start trading natural gas on the spot market.
So this crisis forced them to adapt, basically.
Right. They became more like middlemen in the energy market rather than just those pipeline operators. And it really set the stage for Enron's transformation into, well, a trading powerhouse. But this period also saw a scandal that kind of foreshadowed what was to come later. The Enron oil scandal in 1987, does that ring a bell?
Oh yeah, the one where their traders were basically cooking the books.
More than just cooking the books. It exposed a deeper problem within the company's culture. They were using prearranged deals and off-the-books accounts to move profits around and hide losses. This wasn't just a few rogue traders. It went way higher.
So even early on, they were willing to kind of bend the rules.
Absolutely.
It seems like a lack of ethical oversight and prioritizing profits over, doing the right thing was already ingrained in their DNA.
It was a pattern that just kept repeating itself.
Yeah. So let's fast forward a bit to the 90s. Ken Lay takes over as CEO. Now, he's often portrayed as like the big bad villain of the story, but wasn't there another important figure, Rich Kinder?
Right. Kinder was Enron's president and was known for being really good at operations and keeping the finances in check. He was a lot more cautious and detail-oriented than Lay. Some argue that if he'd stayed, Enron might have avoided disaster.
Interesting. But Kinder left in 96, which is right around when Jeff Skilling enters the picture. The infamous smartest guy in the room.
Yeah, Skilling's arrival was a turning point.
It really feels like it was.
He was undeniably brilliant, but incredibly ambitious, some might even say reckless. He's the one who really pushed Enron to become a trading-focused company, applying all these complex financial strategies and accounting practices to the energy sector. And he brought with him this concept called mark-to-market accounting, which ended up playing a huge role in their downfall.
Mark-to-market sounds, well, kind of innocent.
It does.
Can you explain how it became such a problem for them?
Imagine you've got this contract to supply energy for, say, the next 20 years. Now, with traditional accounting, you'd recognize the revenue from that contract gradually over the 20 years, right?
Right.
But with mark-to-market, you estimate the total profit from the whole contract, and then you book it all immediately, even though you haven't actually earned that money yet.
So basically, they're counting their chickens before they hatch.
Exactly. And on a massive scale. So this creates a huge gap between what their profits look like on paper and the actual cash they have.
I see where this is going.
And that's where the potential for, let's call it, creative accounting really kicks in. Enron took this idea and just ran with it, using really optimistic, often totally inflated projections to make their earnings look amazing. Their international ventures, like the Dabhol power plant in India, are a perfect example of how this can backfire.
Dabhol was supposed to be this huge success story for Enron, right?
Yeah, it was supposed to be a crown jewel in their international portfolio.
But it turned into a total money pit.
It was plagued with problems, cost overruns, political pushback, and they just couldn't sell the electricity they were producing. But the thing is, Enron had already booked all these huge profits based on projections, which made their financials look much healthier than they actually were.
Wow. It sounds like Enron was built on a foundation of smoke and mirrors, creating this illusion of success while, in reality, everything was falling apart.
It really was a house of cards. And to maintain this illusion, they cultivated a corporate culture that rewarded taking big risks and punished anyone who questioned the status quo. Skilling, for example, introduced a rank and yank system. So employees were constantly being evaluated, and if you were at the bottom, you were fired.
So it was this super high-pressure environment where people were encouraged to hit their numbers no matter what.
Exactly. Which brings us to Andrew Fastow, Enron's CFO. He's the one who created the whole web of off-balance sheet partnerships that ultimately brought the company down.
Okay, so let's talk about Fastow and these partnerships, because this is where the real accounting fraud gets going.
Fastow was brilliant, but he was also incredibly ambitious and willing to, let's say, bend the rules. He created these special purpose entities with names like Tuco and LJM. Their whole purpose was to hide Enron's mounting debt and make their earnings look better.
But how did he pull this off without anyone noticing? Didn't they have, auditors and regulators?
That's the big question. It was a massive failure of oversight on multiple levels. From Enron's board of directors to their auditor, Arthur Andersen, there were so many chances to stop this, but it just kept going.
So we were talking about the failure of oversight that allowed Enron to get away with so much for so long. I mean, Arthur Andersen was their auditor, right? Weren't they supposed to be the ones making sure everything was on the up and up?
Yeah, Arthur Andersen, their role it's complicated. I mean, they were the ones who were supposed to be auditing Enron's books, right? They signed off on those misleading financial statements. But at the same time, there's a lot of evidence suggesting that Enron was actively misleading them, hiding information, pressuring them to approve accounting that was, well, questionable.
So is it like a mix of negligence on Andersen's part and Enron just being really good at deception?
Yeah, I think that's a fair assessment. And you can't ignore the conflict of interest either.
Right, because Andersen wasn't just their auditor.
Exactly. They were also doing consulting work for Enron, which means they were kind of auditing their own work in a way. And they had a huge financial incentive to keep Enron happy.
It's a classic case of don't bite the hand that feeds you.
Okay, but even if Andersen was, let's say, less than diligent, those LJM partnerships were at the core of the whole fraud, right? Like, how did those actually work to hide Enron's debt and make their earnings look better?
Well, you have to remember Fastow's background.
Right, all that complex financial stuff. Yeah, he was a master at it. So he created these partnerships as separate entities, technically independent of Enron. But the reality is, they were controlled by Fastow, and they were being used to do business with Enron in a way that made their bottom line look amazing. But it was all totally fraudulent.
One of the things I read described it like a shell game. Can you explain what that means in this context?
It's a really good analogy, actually. Think about those 3 shells, right?
Yeah.
And the ball is under one of them. They're constantly being moved around, so it's really hard to keep track of where the ball really is. That's basically what Fastow was doing. He was moving assets, liabilities, profits, all this stuff between Enron and the LGM partnerships, making it almost impossible to see what was really going on.
And the whole point was to make Enron look more profitable, even though they weren't.
Absolutely. The partnerships let them keep tons of debt off their balance sheet, which of course makes them look less risky to investors. And at the same time, they were using these partnerships to generate fake profits, boosting their earnings even more.
And Enron's board of directors, they just signed off on all of this.
The board's role is really... It's one of the most baffling parts of this whole thing. They were being shown these super complicated transactions, often with very little information and with Skilling and Fastow putting on the pressure. It's possible some board members really believed the partnerships were legitimate, but others, I think, they just chose to ignore the warning signs.
So a mix of maybe not understanding and maybe not wanting to understand. But how long could this go on? Didn't anyone outside of Enron, catch on?
There were people who raised concerns, analysts, journalists. They were starting to ask questions about Enron's accounting, but the company was really good at deflecting criticism. They were still the Wall Street darlings, remember?
Oh, right. And then there was Sharon Watkins, right? The employee who tried to warn Ken Lay.
Sharon Watkins, she's the real hero of this story. She sent this memo to Lay, and it was so detailed, spot on about what was happening. She called out the LJM partnerships, warned that Enron could just implode from all the accounting scandals.
But Lay didn't listen.
He launched an internal investigation, but get this, it was run by Enron's own law firm.
Oh, wow.
Total conflict of interest. They downplayed everything, and ultimately, her warnings were ignored.
It's a classic case of speaking truth to power, and no one wants to hear it. But all this was happening While Enron was also in the news for that whole California energy crisis thing.
Oh, yeah.
Like another example of how far they were willing to go to win, even if it meant hurting other people.
Definitely. Enron's traders, they were taking advantage of the newly deregulated energy market in California. They were doing all this stuff to manipulate prices, making the energy shortages even worse.
Didn't they have, like, names for some of these schemes, like Death Star and Ricochet?
Yeah, they did.
Yeah.
Sounds pretty harmless, right?
Right.
But the impact on California was huge. Rolling blackouts, energy prices going through the roof, billions of dollars in losses for the state.
It's almost like they saw California as their own personal playground to make money no matter who got hurt. And on top of all that, they were trying to get into new businesses, like broadband, right?
Right, Enron broadband. It was another example of their ambition, but also their tendency to, let's say, embellish the truth. Skilling, he wanted to create this market for trading bandwidth, just like they traded natural gas. But the technology wasn't quite there yet, and there just wasn't enough demand.
So how did they make this failing business look good to investors?
The same playbook they'd used before. Creative accounting, super optimistic projections, and a lot of aggressive PR. They even came up with a new metric, total contract value, to make their broadband business seem more valuable than it was.
Total contract value. So basically another way to book future profits they hadn't actually earned yet.
You got it.
It's incredible. Their whole business model was smoke and mirrors, just designed to create this illusion of success, while underneath it was all rotten.
And that illusion, it was carefully maintained by a whole team of people, executives, accountants, lawyers, all willing to cross the line, ethically and legally.
It just goes to show, even the most successful companies can be built on lies. And when those lies fall apart, the consequences can be devastating. It's amazing how long they kept that illusion going, but, you know, by 2001, things were starting to unravel. When Jeff Skilling resigned, like, out of the blue, in August of that year, it was a huge shock.
Yeah, I mean, Skilling was the one who pushed that aggressive trading strategy, the one who really embraced those questionable accounting practices. So when he left, it raised some big red flags about Enron's future.
And then Ken Lay comes back in as CEO, trying to, calm everyone down, saying everything's fine. But the damage was done.
The market just didn't believe it anymore. And their stock price, well, it was plummeting.
Right. All those cracks in their facade were becoming impossible to ignore.
Yeah, the short sellers, the ones who bet against a company, they were starting to smell blood. They could tell that Enron wasn't nearly as healthy as they were pretending to be.
And then the SEC, the Securities and Exchange Commission, they start sniffing around.
Right. They launched an investigation into Enron's accounting, which, definitely added fuel to the fire.
Oh, yeah. So the pressure's building, and Enron's leadership is, like, scrambling, trying to find a way out.
That's when they started talking about a merger with Dynegy, another energy company. They were hoping that would be their lifeline.
But Dynegy, they pulled out, right?
Yeah. They got a look under the hood, saw the real mess Enron was in, and ran for the hills.
It's like that moment in The Wizard of Oz when the curtain gets pulled back.
Exactly. And when that merger fell apart, it was a huge blow for Enron. The market knew they were in serious trouble.
And then the final nail in the coffin. The credit rating agencies downgraded Enron's debt to junk status.
Game over. It set off a chain reaction that led to Enron filing for bankruptcy in December 2001.
Unbelievable. They went from a Wall Street darling to a cautionary tale, like in the blink of an eye.
It really shows how quickly things can unravel.
So after the dust settled, what happened?
Well, the investigation started. Congressional hearings, criminal charges against all those top executives.
Right. And Arthur Andersen, their auditor, did they get in trouble too?
Oh, yeah. Arthur Andersen, once one of the biggest accounting firms, they were convicted of obstruction of justice, all because of those shredded Enron documents.
Wow.
The firm basically imploded. Thousands of people lost their jobs.
So the whole Enron saga, it really sent shockwaves through the business world. Right?
Oh, absolutely. It changed how we think about corporate governance, accounting, everything.
Yeah, and then Congress passed the Sarbanes-Oxley Act in 2002. Stricter accounting rules, auditor independence, more corporate responsibility.
It was a direct response to Enron.
It's a pretty clear lesson,
Yeah.
right? Unchecked ambition, corporate greed, putting profits ahead of everything else. It's a recipe for disaster.
It really is. Enron's a perfect example of that.
And even the most successful companies, they can be built on lies. And when those lies come out, well, we saw what can happen.
Yeah, the consequences can be pretty huge.
This deep dive into Enron, it's been a trip. Seeing how all the pieces fit together, the accounting tricks, the people involved, it really makes you think.
It does.
Like what other Enrons might be out there, right?
Right.
It's a reminder that we all need to be paying attention, asking questions, and holding those in power accountable.
Right.
Because the next Enron, well, could be closer than we think.